All right. It's loading now.
All right, we are live. All right, give people a few minutes to get on. I see myself. Yep, there we go. Yep, our live streaming. Yep, there we go. Yep, our live streaming. Right. Got a few people on. Thank you for everybody that's already hopped on. Make sure to share this with some of your folks. We get more numbers on this live stream. We'll get started in a few minutes. All right, we're getting a few people on board. Go ahead and drop some money emojis below if you're ready to learn a little bit about how to better manage your money. We have some great guests on the line today and a lot of information to give you. So, all right. We have an audience now. So I am going to go ahead and start off the presentation. For those who's your first time joining, this is the Sigma Virtual Hour. This is the Bigger, Better Business series. Bigger, Better Business is the first national program of Phi Beta Sigma Fraternity Incorporated. This is our second edition, part 2, accounting and financial planning. This is so that we can provide you with some knowledge and some information to help you manage your money with your small business better. This is one of the aims of our organization, is to educate the community when it comes to small business, entrepreneurship, and financial planning. So we have a few guests today that I will go ahead and introduce. So myself, I'm Walker Graffia, the host of today's presentation. I have my master's in marketing management from Virginia Commonwealth University, but I'm also alum of Norfolk State University, where I got my undergraduate degree in business. I'll go ahead and introduce our special guests. We have Brother Terrell Fields, as well as Lewis Preston Jr., both alums of Hampton University, but they also received their MBAs, as well as their CPAs and CIAs, and I'll let them go ahead and introduce themselves as well.
Hey, thank you for that, Walker. So good evening, brothers. Anyone else that is on the call. My name is Terrell Fields. As Walker was alluding to, we kind of been in, myself and Lewis has been in the field for, I don't know, decades now. um, we are from Beta Gamma chapter, Hampton University. Today, we're actually wanting to just kind of give you a little bit more with myself. I'm also in the military as well. I'm an officer. I've been doing that for the last 13 years, going on 13 years now. And we hopefully we can provide some information realistically to help you guys, and just provide some general guidance or just some a little bit refresher about essentially what it is to be kind of in the small business accounting. But I'll let Lewis introduce himself as well.
Good evening. My name is Louis Preston. I am a CPA in the state of California. I have over a decade of experience in accounting and finance. I started my career with KPMG, one of the big four accounting firms, and then moved to Toyota Financial Services, one of the largest finance companies, captive finance companies in the world. And currently I work as a consultant as well as kind of doing some bookkeeping on the side. So certainly want to share as much information as I can to help you in your entrepreneurial endeavors.
All right, thank you. Everyone on this call are HBCU alums, and we all met through the fraternity as well. So just put a note in that, and we're all doing big things. So thank you all for taking the time out of your busy schedules to come on and present with us. So without any further ado, just wanted to kind of hop right in there and, get a brief introduction to small business accounting.
Right. So as you guys see listed here, and just some general housekeeping notes, some of this stuff will seem to be repeated, but it's in different contexts. And as well, the goal is more to provide that general guidance. Anything that you need specific help for your specific, needs, we can provide some general guidance. However, we do advise that you do see one-on-one professional help if you do need additional assistance. I just want to go ahead and get that housekeeping note out the way. So as you guys see here, the goal today is to kind of go through some of the small business accounting. Right, when you think of small business accounting, what we're kindly referring to in this presentation, more of the bookkeeping and the managerial, is used to kind of keep that daily financial activities so that you can have that long-term trajectory. Most small businesses defined by pretty much less than $40 million, I think, by the IRS. And in addition to that, the things that kind of define you as a small business is more like your annual revenues, as well as your number of employees. And then there's other local structural things that can move you in and out of different categories. You can go to the next slide. So now we want to talk about why is it important for you to have that accounting in your small business, right? Especially from a financial, which stands out as these different topics. And just to kind of touch on each, right? From a financial monitoring standpoint, that's what that control is more speaking to. It provides a more of a systematic way to actually gauge your financial health of the small business, instead of you having a general sense of what's going on based off of what you visually see. Financially, you'll be able to kind of make more sound decisions because it'll give you more of an accurate picture, which leads into the next bullet there as far as decision making goes. Having those accurate financial records enables for informed decision making. This is why we harp on it, right? You don't want to make, as far as that long-term forecasting that we were talking about, that's how you start to make it, is having accurate accounting. And then there's the other pieces of it just for sustainability, as I just said, for long term, is for legal compliance and tax management. I think a lot of us have heard the saying before, just because you are lack awareness about the law doesn't mean that you're not held accountable for the law, right? So it's like a double entendre for your accounting. We need to make sure that you're doing it so that you're within legal compliance, whatever the local and federal regulations may be. And that's why you want to make sure that you have that accurate accounting. And then for that, and that feeds right into that last bullet, just for business planning. And that kind of double more so business saying where you want to go, where you are now, and where you see your trajectory going. Some examples of that is when you talk about decision making and financial business planning, is that a lot of businesses are known to fail within the first 5 years. These having these kind of as pillars and understanding how they can be leveraged, this can propel you further to down your trajectory. You can go to the next slide. And Lewis is going to touch a little bit more about that financial planning process.
Yeah. So when it comes to financial planning, you can see here there are 5 different categories: budgeting and forecasting, working capital management, capital expenditure planning, risk management, and succession planning. From a business standpoint, you certainly want to understand how your financial outlook is. However, if you speak to accountants, they do not want to disrupt how the business operates. Many times, the business is looking into accounting to kind of provide direction when the opposite should be the case. You don't want accounting to stop you from growing. You want accounting to support you. And so when it comes to like any of these pillars, you want to leverage the information to make sure you're able to do whatever the business needs to do to continue to grow and thrive. So budgeting and forecasting, I think that's probably one of the more familiar kind of topics that businesses are aware of. And it's ultimately managing your spending and creating an outlook for the future. The biggest thing with creating the outlook for the future is there are less surprises when you plan accordingly and properly. Working capital is an accounting term. It basically means your assets and assets minus liabilities, specifically your current assets minus your current liabilities. And ultimately, that's making sure you have enough cash or assets to actually continue operating as a business. If you are in a situation where your liabilities exceed your assets, you're typically going to other funding sources to support your businesses. So you think of like big companies like Amazon and how they always have a loss at the beginning of their company journey. Usually they have some support or funding coming through either debt issuances or investors to actually support the company as it incurs those losses in the short term. But the outlook, so that's that future planning is very bright for the company. And so they have an idea and a plan to achieve profitability. And that's what's very important to investors. It's okay if you lose money now, as long as you're going to make money in the future and be able to pay me back tenfold of what I invested. So I think those are kind of the highlights. I'll kind of skip on the capital expenditures. Those are more so for, I'll breeze over them. Capital expenditures are related to the growth of the company. You are spending with the future in mind. And then risk management, you don't want to take on too much risk. That's a red flag when it comes to your operations, your investors, your debt. If you have a lot of risk in your business, many investors may not want to partner with you. And then succession planning, that's definitely helpful to have accurate accounting so that whoever is planning to succeed you has an accurate outlook and can make that decision of, yes, I'd like to take on this business in the future because the outlook is promising. And so I think it's important from both the person who inherits the business and the person who's given the business to make sure they have an understanding of the financial picture. All right. And then accounting software, there are quite a few options you have when it comes to where all of your financial information lies. For small businesses, 80% of small businesses use QuickBooks, so that is the most popular accounting software. You also have a number of different choices. Here are a few: Zoho Books, Sage, FreshBooks. You can even do accounting in Excel. The most important piece of using any accounting software is that one, you have the understanding of how it works, and you don't want it to take up so much time where you're not able to operate your business. So, for example, if you're a janitor, you provide janitorial services, and you're spending 20 hours a week on accounting, and 20 hours a week on providing your janitorial services, that's not a great picture. And so you want to understand and make it as efficient as possible so that, again, accounting is not preventing you from growing and from doing business. And so some of these softwares just lightens the burden. It makes it a little bit easier to account for everything, automates as much as possible, and then gives you the information you need in a report to make decisions. And then we'll talk about some of those reports in the following slides. All right, establishing a chart of accounts. So a chart of account is ultimately your categorization of all of the things your business does. So some of the things your business is going to do is charge customers. You call that revenue. And when you have different types of products or services, you'll likely want to break out those revenue streams in a single account so that you can track each revenue stream separately. You want to do the same thing for your expenses. You want to do the same thing for your assets, for your liabilities, and for your equity. Equity is basically assets minus liabilities, and ultimately it is your owners, your shareholders percentage of the company. And so they get kind of what's left after assets minus liabilities. So biggest thing with the chart of accounts, it is your foundation for building financial statements. So when you have everything organized and categorized in a nice format in an organized manner, it is much easier to create those financial statements, to understand what your business is doing, to be able to make decisions if you're overspending, underspending, want to grow. It's easy and very important to have everything kind of mapped out using the chart of accounts.
So, kind of what Lewis was saying, just building off what Lewis was saying here, is just some key accounts that are listed in your chart accounts that will be common to pretty much every small business person. That should be right. You see here the actual, tops of assets, liabilities, and expenses that Lewis was just kind of talking about moments ago. And so it's just kind of, you can see what actually is the sub accounts that fall into those brackets. It's kind of key to understand, even from just in layman's, what you have on. If you can kind of understand and how things are classified, it allows you to kind of speak more accurately and understand more accurately the position, the financial position of your company, from a sense of a profitability standpoint or liquidity standpoint, right? From a thinking about like your fixed assets versus your current assets, right? So that's when we start talking about, hey, if something happened, and earlier when Lewis was talking about for your shareholders, questions like, hey, what are your contingency plans? Liquidity specifically speaks to how quick you can turn those assets essentially into cash, or they can be sold off. So that sometimes, depending on your investor or depending on whatever your business strategy, some companies, especially smaller businesses, may want that on their books, depending on your situation, because it starts to talk about how much risk you are exposed to. Um, and that's kind of understanding that if you like to use the janitorial example, if you have more so trucks and things of that nature, or if you have some kind of vacuum, some kind of equipment and things of those nature, now we start to see where those things lay on the books, because it kind of adds to the value of your actual company. And it's key that you kind of know those things because it may take you longer, if anything happens, to recoup the funding in regards to moving those assets. And the same thing goes for kind of liability is essentially known as anything that's just a future financial sacrifice, right? Uh, some of the current ones are, you got to pay something immediately, whether it be lights or something of that nature. And long-term things are more so like notes that you get from a bank. A lot of small businesses start off getting a large note to pay for, equipment and or other things to get them started. Those are going to your long-term liabilities because again, the term of the actual length of time it turns to that you're obligated, the obligation is kind of what defines it as a current versus a long term. It's kind of also plays into when we were talking when he was referring to earlier about leveraging debt to get you started. It's not necessarily always a bad thing, basing on how you do it proportional to everything else that's on your books, and that's why it's also a key part of those charged accounts that you list those things out. And then it kind of the last one out here, as you guys see, is the expenses. Those are the pretty much I like to call them the cost of doing business sometimes. Um, kind of understanding as far as how those things go into different cost of doing business. One is if you need to actually buy something to sell a merchandise and or actually if you're embroidering jackets, a cost of goods sold would be that embedded cost of the actual material itself, opposed to you having the facility that's more so not a cost for the actual, cannot, depending on your methodology, but it's not necessarily a cost of goods sold, but more so a cost of the operating. Um, so that's just kind of some general accounting over terms, so you can kind of understand. And honestly, it's key. And people, you can keep dissecting it down levels further. But the this first overlay pillars are kind of quintessential to kind of getting you in the correct direction. It's often that you find a lot of companies that have freshly started that have not that much of a good grasp on these things, that they blend their understanding, and which leads to inaccurate understanding of the positioning of the business itself. Um, and then just to kind of use the janitorial example again, it's just understanding when they ask you the value of your business and you don't incorporate those things that you also have, sometimes you're doing yourself a disservice, and it won't position you the most appropriate position. You can go on to the next slide. And this is what I'm talking about here, just from that financial visibility of the items, understanding, hey, how much cash I have, opposed to how many things that if a long-term or current, a short-term liability comes due, am I able to cover the cost? And so if you have those accurate charts of accounting, it allows you to actually know what your financial future looks like. Um, and that's where the term, the financial visibility comes in. And as well as it plays into the other portions of this here, from a sense of understanding what kind of preparation is needed to secure your future. Um, from a larger standpoint as well as just from just what you're doing operationally, and that's what the middle two bullets really kind of focus on, your financial future and your budgeting and planning. and a little bit of that third bullet, but at least from that top bullet and at least in some of that bottom bullet, those are the things that will get you shut down that you can't control if you don't follow, right? If there's some local regulations or something like that, and you don't have accurate bookkeeping is from just your chart of accounts is not even right, then you'll start into roll into things doing something that may be inappropriate based off of your locale or even from a federal standpoint, as well as being prepared to, whenever your tax year is supposed to be, your tax filings are supposed to be completed, you want to make sure that you have, again, if we start talking about liquidity, enough on the books that you can kind of cover whatever your actual obligation is from a tax preparational standpoint. You can go on.
Yep, and I want to add something, Terrell, when it
Mhm.
comes to the record keeping and bookkeeping piece. Depending on the industry you're in, the tax liability will shift, especially when it comes to your locality. So if
Yeah,
you're a person that wants to start a restaurant or you want to sell food, when you want to have a bar lounge, you're going to have to pay sales tax. You're going to have to pay food and meals tax. And sometimes your locality may want that tax every month. They might want it every quarter. So if you're doing business thinking you're going to wait to the end of the year to pay all your taxes, you'll probably get shut down before the end of the year, right?
yeah.
Because those are
Hmm.
one of those industries where the city wants their money on time, and
Yeah.
they don't care if you don't have the um, bookkeeping or accounting set up to properly uh, keep track of it.
Yeah, Walker. Yeah, you're spot on. And this is why I said that statement earlier when we kicked it off. Just because you're not aware of something doesn't mean you're not accountable for whatever it may be from a regulatory standpoint and from an operational standpoint. Um, Regardless if you didn't see the bill that came in to get the food delivered, whoever is delivering the food is still going to want to get paid, or you'll stop getting whatever you need to supply your business if you're a restaurant. And that kind of just understanding, um, again, you had having a clear financial picture, that financial visibility of the things that are going on, and that just reiterates how paramount that is. Even if you aren't familiar as well, these just understanding some of these basic things will allow you to begin to shape in that picture, so that when you do figure out what the next steps are from a long-term goal, that's what you'll see. You can go to the next slide. And this is kind of from a transactional standpoint, right? As where I was using the building off the restaurant actual example, just understanding how to classify these transactions as they come in, where it's someone delivery, whether it's something you're using for your actual product going out. Like I said, the jackets, if you're embroidering jackets, understand how you classify these things. Just from debits and credits, how these things hit your actual books. And so the double entry accounting essentially is saying whenever there is it's almost to use the phrase every action has an equal opposite reaction. Essentially, it's just kind of talking about recognizing that in the appropriate place later on the other side, wherever it exists. And I'm going to let Lewis kind of expound on that a little bit more.
Yeah. So record keeping, I'll take a step back and say small businesses and all businesses have two types of accounting they can select from: accrual basis and cash basis. And depending on that selection, it drives basically how bookkeeping and accounting should work. So, from a transactional perspective, it works very differently. When you're filing for a business and you're submitting your records, tax returns, you have to identify and select whether you're an accrual basis company or a cash basis company. Um, the difference is cash basis follows the cash. If you pay an invoice in month one, you record that invoice in month one. That's cash. Accrual basis, it's more so aligned with when the service was provided. And so let's say you receive an invoice for food or a broom. And so you receive the invoice, the good, in month one, but the company didn't invoice you until month two. You don't have any invoice to basically book that expense in month one, but you have a responsibility to kind of know what your business is doing. And you book an accrual as a placeholder until the expense comes in. And so then when the expense comes in, that accrual reverses, your expense hits, and ultimately they offset to have no impact in month two, and your accurate recognition of expense is in month one. So very different types of bases when it comes to accounting that drive your business. And then when you talk about debit and credits, the debit and credit are ultimately the signs that drive whether financial statement lines go up or down. So your financial statement lines are, as you can see, asset, liability, equity, revenue, expense. Based on what type of activity it is or what type of transaction it is, it's going to have two impacts. It's going to have a debit and a credit, each one. So if you buy a broom, ultimately you're paying cash, which is an asset account. Your asset's going to go down because you're paying cash. As a result of paying that cash, you get a broom. Your broom is an asset because now you can use that broom to sweep and do work that earns you revenue or money. And so now, just based on that broom, buying that broom, you have a debit to, let's say, inventory, and a credit to cash. Ultimately, the net impact is zero, but then you also have an impact on expense where ultimately that expense is going to be a negative balance. And that's probably the most important thing. So all assets and liabilities will eventually go to your profit and loss statement, which is revenue and expense. And that's the form that the IRS, that investors, that lenders are most concerned about. What's your profit and loss? And so the asset and liability are like a placeholder, ultimately to move everything to the revenue and expense accounts and to show whether you have an ultimate net profit or loss for the business. So recording transactions or key financial statements, income statement, balance sheet, cash flow statement. I just touched on the income statement. That's also the profit and loss statement. Most important to lenders, the IRS, investors. If you earn under a certain amount, you don't even need to prepare a balance sheet for the IRS. They're more concerned with the income statement, your profit and loss, because that's what they're going to take tax you on. Ultimately, if you made $100,000, you spent $50,000 on things that you needed to run your business, you have a net profit of $50,000. The IRS will tax you based on that $50,000. Balance sheet, it is a placeholder and ultimately represents your net worth. So it is a point in time, and a point in time just means, all right, December 31st, this is what my company outlook is at this point in time, and it changes every time you rerun those numbers. Typically, you rerun them on a monthly basis. If you are a public company, you are required to file quarterly reviews or quarterly statements. And the most important statement is going to be your 10K when you're a public company, which is your annual statement. And again, balance sheet, it's a point in time to give you a sense of how your company is at that point in time. Cash flow statement is sort of what it sounds like. It's tracking how cash is moving. And so anytime cash moves, it has an impact on the cash flow statement. And the way it's built is actually indirectly based on uh, your balance sheet. So the balance sheet has a direct impact on your cash flow statement as well as your income statement. Um, and the cash flow statement is very important to investors as well, and very important in certain industries such as real estate. Um, Real estate, the cash flow statement is king because there are a lot of non-cash activity when it comes to real estate that has an impact on your business. So, for example, a non-cash activity would be depreciation. Managing cash flows.
Yep.
So,
And
go ahead.
so, yeah, I'll go ahead and jump right in there. Just kind of building on what Lewis was just telling about cash flows. I want to say this before I even say it. That just as an understanding, it's like, um, it's understanding. And this is another. I know I say a lot of things are important, but I think that sometimes when people have small businesses, they make the common mistake of not knowing when the cash flow is flowing in and out, right? And I say it's key to understand that because and it's key for that accurate bookkeeping of transactions and things of that nature. Because a lot of times, knowing so just because you sold something doesn't automatically mean you have the money in the bank, right? Or when you make yourself obligated to someone doesn't mean you need to know when you're committed to that when your commitment is, because I sometimes that transactional period in understanding the true nature of when the cash is flowing in and out sometimes has puts a lot of financial strain on businesses because they don't have an accurate understanding of the timing and the impacts of those inflows and outflows, which obviously feeds into how you manage the cash. As an example, I know a lot of people that do events. Sometimes when you sell tickets, doesn't mean you sold a ticket. Yes, all that says is it's been exchanged on a lot of people uses platforms. Doesn't necessarily mean you have the cash in your pocket to do anything to support your business immediately. A lot of times those platforms have a lag time, not to mention the amount of fees and things that go into that. And so understanding that cash inflow, just the process, this life cycle, um, just understanding that it allows you to make smarter decisions and actually have a more accurate depiction of what your business is. And that's a lot of, I mean, it's 2023 now. A lot of businesses use platforms to process money. I know that firm I was working for was a financial, had money transmitter licenses in all 50 states. And you find that those look different in different states based on your locale as well. Because some places they can only allow you to process it at certain things after certain requirements are met. Um, and so that's kind of key in understanding the cash inflows and outflows, just for some future predictions. Um, if you I really want to harp on that and understanding just because you sold something doesn't mean you have the money in the account. And so understanding when all that stuff transactional happens because you have obligations um, that'll come due, short-term notes or whatever it may be. It's a common misconception of sometimes for smaller business people to not necessarily be tracking that the most accurate way. I always, as from all my clients, I've always told them, you need to kind of scenario plan, to say, hey, this is coming due. What is if you had to if some of your obligations come due now, what could we do? And what is your plan? And also, if especially when you're relying on talking about third party vendors, and I know that they provide a lot of uh, SLAs, just some service agreements. But there also you need to have some contingency planning, and that's why you need to have a strong grasp on your cash flow management, so that you have appropriate techniques to safeguard yourself and the business itself. Um, I see that some questions are coming in from this, the actual Facebook. Yes, so all digital platforms were required to start to report to the IRS. It is starting at a $600 dollar increment. Um, However, there are some other things that go along with that. That was like the blanketed statement and the general principle from a lot of things that come out from the federal is that you can add to, but you can't necessarily take away. So just kind of understand what that means for you. Is so you don't, even if you don't say something to them, they're reporting it up irregardless. So just kind of really be cognizant of that. However, that's where that appropriate classification come in because I know, like I said, those platforms they have fees, and so when you get that breakout from them, make sure you know what the fees are. And also when you're setting up, I know I'm familiar with sometimes Eventbrite. I don't know if it's changed recently, but sometimes you can classify those tickets that you're selling, or even if you're selling merchandise, if you make sure that you appropriately classify it, right? Or if you're doing a service and you're trying to use one of those platforms as well, there is a transactional fee for when we start talking providing services. You don't may not have to pay taxes uh, a certain tax obligation for that. Where opposed to if you're selling merchandise, there is a different tax obligation that is required that you commit when you sell actual merchandise. So it's kind of understanding what your platform has out there as well as what you're doing. I always say safeguard yourself. Worst case scenario, that's where that importance of cash flow management comes in. In addition to that, as far as your future cash flows goes, and this is all plays into it. Uh, some of the challenges, like I said earlier, was not accurately understanding the timing of things and not accurately understanding what your commitment is from a cash flow standpoint. So if you can that's along with the accurate transaction, that's kind of the most appropriate things to kind of keep in mind when you start talking about managing your cash flow. When does the money actually in hand? And then additional to that, what are your actual obligations that are, and when are they due? The timeliness and understanding that life cycle is paramount. You can go on, Lewis. Walker. You can keep going. And Lewis is going to kind of touch more so about that budgeting aspect of it.
Yeah. So creating a budget for small businesses, there are a number of different ways to set up a budget. A lot of a lot of them are free. If you use, and some you can actually use like individuals type applications to kind of track your business. Um, Sometimes they charge less for an individual than it does for a business if you're a sole proprietor or a single um, person operating the business, then that may be a way to kind of save some costs. But ultimately, when you're creating a budget, you want to um, understand what are the core expenses of your business. Um, what do you need to operate? And you need to structure your budget. My recommendation would be in two categories: fixed and variable costs. Your fixed costs are going to be expenses that don't fluctuate month to month. For example, if you are leasing a space, your lease shouldn't fluctuate within the term of the contract, versus a variable expense might be, let's say, utilities. So you're paying water and you are a beer company. And so you ultimately use quite a bit of water to um, provide service and create the product that you sell to customers. So that's going to fluctuate a lot just based on the demand of your product. And so once you have those two categories set up and your expenses divided into those two categories, then it's a little easier to forecast and make decisions based on that budget. Ultimately, you don't want to operate again at a loss. And so understanding, all right, these fixed expenses are the minimum I need in order, in terms of revenue, to create a loss. Come up with that break-even analysis so you know how many units you need to sell to break even, and also to reach your target revenue goals or profit goals. Those are some of the things that you want to kind of keep in mind as you're creating a budget. And again, I think some of the apps that I'd recommend if you're an individual or small business would be like Mint.com. Mint will actually be shutting down come January 1st and migrating to Credit Karma, but it'll still have some of the monitoring capabilities. And then you also have Empower, which is another individual app. So those are free apps. And then when you get into your paid subscription licenses like QuickBooks, those are kind of your all encompassing accounting software tools that include a budgeting feature for you to kind of monitor your expenses on a monthly basis.
We actually have a question in the chat. Ocasio asked that what profit margin would you tell a business owner they may want to consider a different business plan?
To be honest, it depends on the market, right? At different markets have different profit margins. So that's kind of an independent, answer. And then also not even you can split it up like even down further. Market what segment if you're doing retail versus food and beverage versus you're doing some kind of service, some kind of service provider, like you're a consultant. So it kind of depends there. A good rule of thumb is to kind of and this goes back into what we said already, right? Understanding what other obligations you have from an expense or from a liability standpoint, and it kind of you can build it from there, right? And that's from holistically speaking. And I say that from just operational expenses, personal expenses if you're the owner, tax expenses, tax liabilities, all these kind of things. It will allow you to then build in to say, hey, and what is the market looking at? It's always a paramount. You kind of see what market research as well, just to kind of tell you more accurately what you should be looking at. So it really depends on the market segment.
Yeah, and I'll just add, profit margin. So the definition of it is your revenue minus your expenses equals profit margin or profit or gross profit. And then your gross profit as a percentage of revenue is your profit margin. And so like the break-even analysis formula is kind of crucial, where you can kind of work backwards to determine, all right, is this an appropriate profit margin based on the number of units I plan to sell? What are my variable costs? What are my fixed costs? All of those components are factored into the break-even analysis. And you can get a break-even analysis calculator off the internet, plug in the numbers, and it will tell you, all right, based on this profit margin, this is how many units I need to sell. So it's really just kind of easy math when it comes down to it. And you can use calculators to kind of do the math for you in order to determine if your profit margin is appropriate.
Yep, and typically I know with my marketing company, we did some research and found that, 15 to 20% on average across industries is a solid profit margin of the total revenue. So if 15 to 20% of your total revenues is profit, you're typically doing pretty good. Of course, that could adjust per industry. And of course, people want to maximize their profits, but that's just like a rule of thumb to throw out there.
So kind of just moving, this kind of goes into what we were saying a minute ago, right? So it's obligations. I know I said a few times, as far as the tax and how this accurate accounting falls into the actual tax obligations, you really need to understand what that looks like for your different market, and whatever sector you're in, because you remember there are some overarching federal things that are going to come down, and that's like the guidance on regards to the reporting from electronic money transmitters, as well as there's some state and local can be even as small as your local town or your local city or borough, wherever you are geographically at. The planning techniques is, like I said, build it in. You can't necessarily sometimes forecast to the accurate, but you can just kind of forecast an estimation. If you know what it gets real accurate depending on what segment. If you were to say, I sell this amount of units, this how much of the tax obligation will be. And kind of like what Lewis was saying, there's a lot of calculators out there. Understanding the tax code changes a lot. So definitely always stay abreast. And like I said in the beginning as well, and if you need professional assistance, you're more likely, more than welcome, should reach out so that you can get that one-on-one information. In addition to that, as far as deductions and credits, this is for every small business owner. And if you just kind of back into what we were saying earlier about accurate transactional and bookkeeping, is because sometimes when we don't have an understanding of what's going on, we don't have an accurate depiction of what is eligible to be captured appropriately on our taxes, for write-offs and or just for credits, to be honest. Just as an example, sometimes when people, I know we had the what is it? The SBA was given out during COVID. A lot of people relief for paying salaries and things of that nature. And if you had accurate recording, you were able to kind of recoup and give yourself relief when it comes to those natures. And then the other part of that as well, especially if anyone got those PPP loans that were going out, the IRS, and I know we processed a few of them, and I know that the IRS is very particular on what they want to know. Some of those PPP loans, they wanted to see everything in your books. Now, does that mean that's what the government is doing for all those things? Not necessarily, but when they come calling, you want to make sure that you're in the most appropriate position to make sure that you're in the most appropriate position to give them the information that they ask from a transactional standpoint. There was a lot of stipulations, just again, using the PPP as an example. There's a lot of stipulations that you weren't supposed to incur any additional expenses that were outrageous, essentially, that were unusual expenses and then that weren't used for like operational purposes. So there was a lot of stipulations that went around those. So it's kind of key that that's where you understand from what your obligation would be from that standpoint. As far as working with a tax professional, I said that before. Just if not anything else, sometimes it's easy just to have that initial consultation just to get advice. I do recommend that. It's even if you know everything, sometimes it's good just to have some additional advice, just so that you can, better poise yourself for the future, or even improve anything that you're doing now. Because as I initially stated, the tax regulation constantly change. I know it becomes more stringent as time goes on. Prime example, cryptocurrency. When it initially came out, There wasn't a requirement to you to put that on your actual 1040s or file with your taxes. It wasn't necessarily a harder requirement. It was more so implied because they were gains. But as time has went on, there's been more development in that segment. And those are just kind of just direct examples of saying, understanding what your tax obligation is going to be and the impact it can have on your business. Again, a lot of those people from that weren't appropriately filing the information or falsely filing information for the PPP loans. Either some were financially penalized and some were put in jail. So it's kind of understanding that, even from those are blue collar crimes that go on will still, have dire consequences. So it's really paramount that when you're doing your financial planning, that those tax obligations are really embedded in those planning techniques. You go ahead.
All right. So best practices for small business financial management. Separate business and personal finances. That's key. Another word for that is piercing the corporate veil when you kind of commingle those things. So when you create your small business, create a separate bank account. And if you do have some expenses that are split, very clearly document what percentages of that expense relates to the business. And that's going to be key in any kind of evidence if you were to get audited as proof of records. Regularly reconciling your accounts. When it comes to reconciliations, you typically only reconcile the balance sheet account. So that's that statement we spoke about earlier. Ultimately, when you reconcile the balance sheet account, everything else is kind of reconciled because it's feeding the cash flow statement. It's feeding the income statement. So reconciling your balance sheet accounts on a monthly basis is important. You also want to kind of take into consideration the cost benefit when it comes to time of doing those reconciliations. So if it's a very complex reconciliation or it's a very time-consuming reconciliation, maybe do it quarterly instead of monthly, so that it's not taken away from the business, but you still have on a quarterly basis accurate financial statements. And then you also want to take into consideration how frequently you're actually reporting. So let's say you have a requirement to report monthly because of sales and franchise tax. You probably want to do those reconciliations monthly to make sure you're reporting accurately. Seek professional advice. That's always kind of key. I think Terrell's kind of touched on that a little bit, so I'll skip that. And then stay informed about financial trends and regulations. I think an important time to do that is definitely annually at a minimum. And so when you meet with your tax advisor or you're going through your financial records to report on your tax return, review and make sure that the regulation that you adhere to, you're in compliance. And so I think annually is fine. If there are things that are changing, some publications actually are very good when it comes to kind of changes. Small business administration has some information that you can always leverage. Your tax accountant is going to have some information you can leverage. There are a number of sources that you can kind of use to make sure you're in regulation or in compliance.
So I know there has not been any new questions that we haven't already answered in the chat. I appreciate and want to thank the special guests, Terrell Fields and Lewis Preston, for coming on the show with us to talk about small business accounting and financial planning. We're going to have our next series is going to be next month. The date is, let me go pull it up.
Hey, look, while you're looking at that, Walker, I just want to say thank you for allowing us to come on. I know we kind of said this in the beginning very briefly, but definitely willing to, if anyone has any questions or needs some financial advice or things of that nature, you can definitely first touch bases with Lewis if you feel more comfortable with that. As you just said earlier, you can look us up on LinkedIn and reach out. I know this is being recorded, so once you review the presentation, you'll see our name listed here, and you should probably seen it on the slide as well. Lewis does have, we have started a bookkeeping firm for those inquiries as well.
Yes. The next call will be December 19th. And that will be entitled The Power of Digital Marketing. We're going to have some more special guests and talk about digital marketing on that slide. I am going to go back to the beginning of the presentation, and I'm going to show the names of both special guests so you can go ahead and follow them. All right. All right. So, Brother Preston, is there anything that you want to share? Any last words from you?
Yeah, no, absolutely. Thank you for allowing me to come and present on this topic. I think, as Terrell mentioned, I do have a bookkeeping business called Preston Financial Services. If you're interested in bookkeeping services, please reach out. I also offer business transformation, where I can automate your processes related to either your financial records or operationally, as well as planning related to either doing like a cost benefit analysis. Someone asked a question about profit margin, helping you identify what the correct pricing structure is for your company. So happy to assist you as much as I can and be a resource to you.
All right. That sounds amazing. Thank you once again, brothers. You'll have a great night, and we'll see you all on the next Sigma Virtual Hour.